All right, let's keep going. We have here a slide regarding revenue and expense recognition. We have already talked about this. We talked about revenue and expense recognition. They are key parts of accrual-based accounting. If we were using cash-basis accounting, we would just, recognize revenue when we received the money and recognize an expense when we paid out money. But we've already said that's not how we're going to do things under accrual-based accounting. So we're going to go over these again. And if you notice that in the first few chapters, we go over a lot of the same stuff. That is on purpose to help you understand. And if we get through these first few chapters and you have trouble, always reach out to me. All right. Under the expense recognition principle, the expenses incurred in generating revenue must be reported in the same period as the related revenue. This is also called the matching principle. Now, that's a mouthful there. So let me give you an example of what it is we're talking about. All right. I want you to think about a business that has a pay period that ends on December the 26th. All right, December the 26th. And this business is going to be open December 27th, 28th, 29th, 30th, and the 31st. So however many days that is, I believe 5 days. All right. Now, it really doesn't matter if this business pays once a week or bi-weekly every couple of weeks. 5 days is less than 7 days, and it's less, which is a week, and it's less than 14 days, which is 2 weeks. So what happens is this: those employees for this business, for that 5-day period from December the 27th through December the 31st, they're doing whatever it is they do, depending on what type of business it is, to help generate revenues towards the end of December of the current year. Now, those employees, let's say that it's a bi-weekly payroll schedule, those employees are going to get paid. Let's say that payroll period ends on, it goes from December the 27th through January the 9th, which I think is 14 days. They're going to get paid for that entire 14 days, 5 days in this year, and then 9 days in the next year, all in the next year. Okay, but we can't recognize all 14 of those days in next year's expenses because 5 of those days' expenses for salary, wage expense took place this year. So we have to split that up, right? So even though we haven't paid them yet, we're going to recognize 5 days of that payroll in the current year because that's whenever the revenues matched to that labor were generated. That's why we call it the matching principle. Okay. It says further information. It says by matching revenues and expenses, net income or loss for the period is properly reported on the income statement. So think about this for a moment. What if we went ahead and counted all of the revenues for December 27th through December the 31st on the income statement? We counted that over in our revenues, but we didn't count the wage expense because we hadn't paid it until the next year. Well, that's going to artificially inflate our net income. So we have revenue at the top, then we have all of our expenses, and wage expense is going to be one of those, and it's going to be understated by 5 days, right? And then we get down to the bottom and we have net income, or we might also call net income profit. So again, revenues, net income / profit, not the same thing. Let's see what else we have here. It says adjusting entries are required to properly match these revenues and expenses. That's what we've been talking about for the past, almost 5 minutes now. All right, so let's move on to the next slide. The adjusting process. At the end of an accounting period, an unadjusted trial balance is prepared to verify that the total debit balances equal the total credit balances. And also to make sure that everything looks like it makes sense. I mean, we talked about this already. The debits and credits are going to balance. They're going to be equal. It's a matter of do we look at our unadjusted trial balance and see anything that is obviously wrong? Okay. Now, the answer to that is yes, we will. But looking at, some of these accounts, it says, look, if we drop down here, it says many of these account balances are reported in the financial statements without change. What that means is that the total on the unadjusted trial balance is going to be the same total on what we're going to be doing in this chapter, an adjusted trial balance, and maybe even the same on what's called a closing trial balance, which we're going to get to next chapter. Okay, so a good example of that would be cash. We shouldn't be adjusting cash at the end of the period. Okay, so a lot of the accounts that we have will not require adjustment. You're not going to have to adjust every single account. Only accounts that involve those accruals or deferrals that we talked about briefly. And we'll give some examples in some other videos and so forth. But look here on this little diagram that I just kind of pulled off the internet. It says some expenses are not recorded daily. So we have to go in at the end of the period and account for those. And we're going to look at some examples. Some revenues and expenses are incurred as time passes rather than as separate transactions. Again, this may not make any sense to you at all right now, but we're going to get to it. And then finally, some revenues and some expenses may be unrecorded. This is part of the adjusting process. Okay, let's move on, and hopefully this will slowly become clearer to you as we go. So along those lines, it says, we just talked about this, some expenses are not recorded daily. It says, for example, the daily use of supplies would require many entries with small amounts. So think about this. You work in an office setting and you need a new pencil. And there are 150 pencils in the supply closet. Okay? Well, it might, rather than record the expense of that one pencil every time someone takes it, which is not practical, what we might say is, okay, over the course of this month, we started off with 50 pencils, we bought 150, that gave us 200, and now at the end of the period, at the end of this month, we have 100 pencils left. That means, we used 100 pencils. What is the cost per pencil and so forth? So we make an adjusting entry, kind of like we did with the Net Solutions example. If you recall, we had $1,350 of supplies. At the end of the month, the owner, Chris Clark, counted the supplies, and the value of those supplies on hand were $550. Therefore, he knew he needed to he knew that he needed to record supplies expense of $800, the difference between $1,350 and $550. I said at that time that was actually an adjusting entry that we weren't going to cover until the next chapter. Well, now we're in the next chapter. The second one, it says, some revenues and expenses are incurred as time passes rather than as separate transactions. And they give the example here. For example, rent received in advance, unearned rent, expires and becomes revenue with the passage of time. So we had, let's see if I can get this where we can read it or see it. We had the transaction, we may have skipped over it, but it was in the last chapter where, if you recall, Net Solutions had bought the land for $20,000, and they actually rented that land out to somebody, and they collected $360. But here's the thing. That $360 that they received was actually for 3 months, or $120 per month. Okay, so when they received that $360 in advance, they had unearned rent, which is a type of unearned revenue, which is a liability. All right. At the end of that first month, $120 of that had been earned. They didn't have $360 of unearned rent anymore. Now they had $120 of rent revenue and $240 of unearned rent. Okay, so they still have a liability, but only for 2/3 of the amount. At the end of the 3 months, they have no liability and they have $360 in rent revenue. So that's an example of an adjusting entry. Where are we at here? It says some revenues and expenses may be unrecorded at the end of the accounting period. Okay. For example, a company may have provided services to customers that it has not billed or recorded at the end of the accounting period. Okay. And it's very customary in my line of work in accounting. We have thousands of clients in public accounting, and at the end of the month we simply go through all of the billing sheets and we say, okay, what work have we performed, what revenue have we earned for this client, and then at that point we go in and we create a bill, and when we do that we generate revenue. We have an account receivable, which is our asset, and then we have revenue, which is our credit. Okay, because revenue has to be a credit because our asset, whether it's cash or accounts receivable, went up with a debit. All right. Let's see here. Okay, so this is just a little bit of vocabulary here. It says the analysis and updating of accounts at the end of the period before the financial statements are prepared is called the adjusting process. There are certain accounts, again, that we're going to adjust, others we're going to leave alone. The journal entries that bring the accounts up to date at the end of the accounting period are called adjusting entries. Okay, so we would have regular journal entries, which will be the vast majority of the entries that we're going to be looking at, but we'll also have some adjusting entries. A huge adjusting entry for almost every business is adjusting entries with regard to wages payable and wages expense. And we had some examples of wages in the previous chapter with our net solutions example, but we didn't have a liability. They were just working, and then at the end of the 2 weeks they were getting paid. So we never were accruing a liability there. In this chapter, we're going to do it more the correct way. All right, let's see what else we have here. Very important, it says all adjusting entries affect at least one income statement account and one balance sheet account. Thus, an adjusting entry will always involve a revenue or an expense account and an asset or a liability account. So let's think about this. I gave you the example of the 5 days at the end of the year that we're not going to be paid until sometime in the next year, right? And let's just say that that 5 days, our employees make an average of $2,000 a day total between all the employees, and times 5 days, that's $10,000. So what we would do, okay, is in order for that $10,000 to count as an expense, we're going to debit wage expense and then we're going to credit wages payable. I'm going to abbreviate, and both of these are going to be I'm going to run out of room here, so I'm going to say 10K, $10,000, okay? All right, so the wages expense is our income statement account, and wages payable is a liability on the balance sheet. Okay, so in this case, we affected one expense account and one liability account, right? All right, let's see what else we have here. All right, so we have a couple of types of adjusting entries. We have what are called deferrals and accruals. You've seen pretty much all of these so far. When we talk about deferrals, we have prepaid expenses, and what that means is we are deferring the benefit until the future. So let's look at this. It says expenses paid in cash and recorded as assets, prepaid expenses, before they are used or consumed. And the example that we had at the very beginning of this chapter was insurance. We paid for 6 months, so we prepaid that expense, right? And that's an asset. It's a prepaid insurance account on our balance sheet. Okay, so and it's going to take us, we're deferring the benefit partially for, say, 1 month, and it's going to take us, we're going to defer, in our example of 6 months, we're going to defer the full benefit of that asset over that 6-month period of time. Unearned revenues. Well, if we have not earned the revenues, we can't count the revenues. Accrual basis accounting. So going to our net solutions example with the rent, net solutions received the $360 cash before their renters actually got use of the land. So they got $360 for 3 months, $120 a month. They are deferring the recognition of that revenue until it has been earned. After 1 month, they can record $120 of revenue, and then we can get rid of $120 in unearned revenue. Why? Because now it's not unearned; it's been earned. Okay. Accruals works the same way. So think about it. Accrued revenues says revenues for services performed but not yet received in cash or recorded. So a real good example of this is, every once in a while we will have a business and we'll have clients, and we'll say, okay, depending on what the type of business is, we'll say something like, we have a contract here for $50,000, and we're allowed to bill this contract every time, we're allowed to bill on this every time we complete 25% of the contract. End of the first month, we look at it and we say, okay, we've completed 50% of the work. It's a $50,000 contract. We can record now $25,000 of earned revenues. Okay, we can set up an accounts receivable for that, and we're going to credit revenues. Accrued expenses work the exact same way. Okay, think about your utility bill. You can't pay a bill if you don't know how much it is, can you? But you might know, okay, well, my electric bill for my business is always somewhere between $480 and $520. Now, if you're an individual proprietor with a small business, it really doesn't matter. But again, we have to make an attempt to accrue those expenses before we pay the money. Otherwise, we can't get it on the income statement for the proper period. The other example that we've already had is the wage expense example. Remember the 5 days at the end of December? Right. Okay, this video is starting to get a little bit long, so I'm going to go ahead and cut this off. I know we're moving through this chapter painfully slowly, but this material is not easy. It's not a piece of cake. So we need to take it in small pieces and chew it up carefully so we don't choke on it. And if you'll stay with me, you will learn the information well enough, get through these first few chapters, and then we're getting into a little bit more of the finer points of accounting, and you won't be so stressed out by this stuff. All right, that's it for this video.